A reminder, in this week's fastest 4 minutes in finance, not to make investment decisions based on expert predictions. Hello, and thanks for checking us out this week. I'm Scott Inman. Well, volatility has returned to the stock market. It's certainly been a choppy start to 2025. And after 2 straight years of 20% returns, investors are asking, can we keep it up? Well, the consensus from the experts is yes. At least the consensus from the experts LPL Research averaged for us. Wall Street has significantly upped their 2025 forecast for the S&P 500 index over the past few months. Strategist price targets currently range from 6,000 to 7,100. The average price target for the end of 2025 is 6,614. That would be an almost 12% return from where the index sits as we record this segment. Now, LPL points out there are lots of things driving Wall Street strategist optimism. Inflation still moving in the right direction and corporate earnings climbing to double-digit growth rates are 2 of the big ones. Now, it's human nature to think what goes up must come down, especially after 2 straight years of 20% gains. But Ryan Dietrich, chief market strategist for Carson Group, shares his research that shows big years are often followed up by big years. Check this chart out. In any year, the S&P 500 index is up on average 9.5% and is positive 72% of the time. In the year following a 20% gain, the index is up 10.6% on average and higher 81% of the time. But in the year following back-to-back 20% gains, it's up 20% on average again, and it's positive 100% of the time. Now, it is important to point out the index has only produced back-to-back 20% gains 4 times in history, so it is a small sample size. Back to those Wall Street predictions, though. LPL wondered, how often are they right? Well, the answer, not very often. Here's a graph comparing the average strategist price target with the actual index performance over the past decade. You can see the bars line up only once in 2016. LPL tells us analysts actually underestimated market performance in every year since 2019, with the exception of 2022. And then going back all the way to 2004, analysts have overestimated year-end forecasts by an average of 7% and underestimated the index return in only 7 of the past 20 years. Bottom line is, the best minds in the industry are most often wrong when it comes to predicting market returns over the short term. But stocks have been generally predictable over the long term, and this makes our case that stocks should be considered long-term investments. Nobody knows specifically what will happen in any given year, but investing in stocks over a long time horizon is still the best way to reach your financial goals. Thanks for watching.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.